What are dividends, and are they good or bad for investors? How do you determine the amount of dividends that a company pays its investors? And should you treat Social Security retirement payments as part of your bond portfolio? We'll answer these questions and more on this, the 96th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Well, I'm going to try something new today. I'm actually going to try to incorporate a video component in today's podcast. Of course, if you're listening to this in your car or anywhere not in front of a computer, you'll have to wait to see the video, I guess, when you get to in front of a computer or an iPad or something. But I'll explain what I'm doing in a minute when we get to it. And hopefully I'll be able to pull this off. We'll see. But it occurred to me we're going to be talking about dividends. This is sort of the first in what I think will be, well, I know will be a several-part series on dividend investing. I'll mix it up. I won't do, podcasts just about dividends over the next week or so. I'll probably do one a week on this topic, but I think it's going to be a 3 or 4 part series, maybe more. And so today's part 1. And I thought with some of this, it's easier to show you than it is just to describe it in an audio podcast. So I'm going to work on hopefully produce here in the show a screencast that I can then upload to YouTube and play it for you and embed it into the show notes of the podcast for today. So that's what I'm going to try to do. We'll see how it goes. Before I get to all of that, though, I have a sort of a money tip of the day, and it deals with Social Security retirement payments. I've had this question come up a number of times, including recently from folks where they say, I'm going to be getting Social Security payments, retirement payments, of course, when I begin electing to receive Social Security. Some folks have a pension as well. These are sort of guaranteed, or at least as guaranteed as it comes, payments. And they're wondering, in terms of coming up with my asset allocation during retirement, how should I factor in those payments? Social Security payments, possibly pension payments. Shouldn't I treat those as sort of part of my bond portfolio? And if so, how do I go about doing that? So that's the question that's come up. And I just thought before we get to the dividends, sort of a money tip of the day, I will say, first of all, I'm not convinced that we should treat these annuity type payments as part of our bond portfolio. And here's why. Regardless of how much we get from a pension, Social Security, we're still going to need X dollars, whatever the amount is, from our nest egg. Could be a little, could be a lot. Obviously, it will be less given the Social Security payments that we receive, and perhaps if you have a pension, the pension you're going to receive. But we're still going to need to generate some amount of income from our nest egg, whatever that is. And it seems to me that how we allocate that nest egg should really be governed by how much income we need to generate from it and our appetite for risk. If we have to rely on our nest egg for some amount of money, to me, that should be the driving factor in how we invest it. Now, that being said, there are some really smart people who disagree with me. And of course, as I now look for my notes that I laid down before I started this podcast, I can't find them. Well, here we go. This was an article from the Wall Street Journal, and one of the things that they point out is that none other than John Bogle, the founder of Vanguard, says that the bond allocation, should factor in pensions and Social Security. He says that the bond part of your asset allocation should include any pension along with Social Security. That's his view, and he's a pretty smart guy. And so then the question becomes, okay, if you want to follow that approach, how exactly does that work? I mean, for example, let's assume you got $1 million in your nest egg, and you're getting, we'll just pick a number, $30,000 a year in Social Security. All right, well, how exactly do you translate the $30,000 a year into a number that you can then use to do some sort of asset allocation? For example, let's assume you wanted 60% stocks, 40% bonds. All right. Well, how does the Social Security? It's $30,000 a year. How does that fit into your other $1 million and figuring out how it should affect your allocation? If you ignored Social Security, then it's easy, right? $600,000 would go into stock or stock mutual funds or ETFs, and $400,000 would go into bonds, right? That's simple. But now, how do we make the Social Security component work? Well, in this Wall Street Journal article, and it's called Stock Exposure for Retirement Years. So you can Google it and find it. I save a lot of articles from the Wall Street Journal that I like. This one actually came out February 4th, 2014. But in this article, they had a rule of thumb. This came from the head of retirement research at Morningstar. His name is David Blanchett. And what he said was you should take your annual benefit, whether it's just Social Security or including pensions, and multiply it by 15. So if you have $30,000 a year, you multiply that by 15. 30,000 by 15, I'm pretty sure is $450,000. And you would attribute that kind of value to it. So you'd have $1 million in your IRA, and you would assume that your Social Security is worth $450,000, multiplying it by 15. So that would give you a total of $1.45 million, and you'd just divide it up. 60%, if that's your asset allocation, 60% of that would go to stocks, and 40% would go to bonds. And so what does that look like? Well, I'm gonna pull up my trusty calculator here so I don't get the numbers wrong, and I'm punching in 1.45 million times 0.4. would mean your bond allocation would be $580,000. So you've already got the $450 that's attributed to Social Security. You'd add another $130,000 in bonds out of your $1 million, and the rest would go to stocks. And at least if you buy into this view and you think multiplying your Social Security annual benefits by 15 is the right way to go, and it strikes me as somewhat reasonable, you'd end up putting about $130,000 of your $1 million in bonds, plus what you've got for Social Security is already there, and the rest of your $1 million would go to a stock mutual fund or ETF or however you're investing. That's a big difference. If you ignore Social Security, you're going to have a lot more in bonds out of that $1 million. So it's an approach. I'm still not convinced, but again, I'm only 47, so I don't have to worry about this decision right now. But I know a lot of you do, and I thought I'd just quickly kind of walk through that. Maybe I'll put together an article for the blog and mention it in an upcoming show, because I know running through those numbers like that pretty quickly can make anybody's eyes glaze over. But that's why I wanted to kind of throw that out there for those that are confronting that decision, how you might actually go about translating Social Security payments into some kind of amount that you could then determine what your allocation should be. Head of retirement research at Morningstar says multiply by 15. By the way, the interesting thing there is how interest rates might affect that number 15. Should they go up or down as interest rates rise? But perhaps that's for another show. So there's the money tip of the day. Hope you find it helpful if you're in that situation. Again, the Wall Street Journal article from February 4th, 2014, Stock Exposure for Retirement Years. Really a good article. And actually, I'm looking at it now. I'm turning the page over. What you might want to search for is how much stock should you own in retirement. That's actually the full name of the article, and it was written by Kelly Green, Greene. A great article. I'm sure you can find it on Google if you search it and find it on the Wall Street Journal. So there's the money tip of the day. Okay, now we're going to go right to dividends, and I got a lot going on here. I'm going to try to work this video here in a minute, which I'll get to. So what I want to do really with this series is give you my approach to investing, particularly as it relates to dividends. I think dividends are a critical part of investing for a lot of reasons. So what I thought today in this part one of this series is to kind of just cover the basics. For some of you, this may be, you may have covered this a long time ago, and maybe it's a refresher course. For others, it could be brand new. But it's really, really important. And so what I want to begin with, the first question is, what the heck is a dividend? And rather than talking about stocks for the moment and large corporations, I want to kind of bring this down to a more practical example. And I want to use as an example a dry cleaner. Why not? And imagine you're going to buy, it's a privately owned company, you're going to buy a dry cleaner, and you're going to buy the whole thing. You buy all the stock in this private company. It costs you $1 million. Now you own the dry cleaner. And, the management's there. You don't know a thing about running the dry cleaner. So you say, look, keep doing what you're doing. I've evaluated the business. You guys are doing great. Just keep up the good work. And you come back a year later And sure enough, they've done a great job. I have no idea what dry cleaners make, but let's assume they had revenue of, I don't know, $5 million. That's probably unrealistic, but we'll assume it's a really good operation. And of course, they have expenses, right? They've got to pay for supplies, they've got to pay for marketing, they've got to pay their employees, equipment breaks, they've got to get it fixed, and all that sort of thing. They have to pay credit card processing fees, and the list goes on and on and on. But let's assume you made a profit of $1 million. Good for you. Now, what happens to that money? Now, of course, since you're the sole owner of this company, you really get to decide. But what are the options? What are the possibilities that a company, what do they do with their profit, with the money that they earn? Well, the first thing that they might do is invest in the company just so they can maintain the good work that they're doing. So, for example, in the course of that year, maybe some of the equipment that they use broke down, or maybe it became obsolete, and new advances and dry cleaning equipment have come out. And so you need to invest some of your profits just to maintain the business you've got. You're not expanding. You're not, at this point, there's nothing to do with expansion. You just want to keep what you've got, maintain your business. So you need some capital investment to do that. And so, whatever the number might be, one year it might be very little, the next year it might be all of your profit. But maybe from year to year, let's say it's, $250,000 to keep up the machinery and to invest in new machines and that sort of thing, maybe new payment processing systems and that sort of thing. And so, of your $1 million, 25% goes to just maintaining the business you have, the capital investment you need just to maintain what you've got. All right, and then what else would you use the money for? Well, you could expand. That would be an option. You could decide, hey, this is a great location. You guys are doing great. Let's open up a second location, and that's going to, of course, require some capital. So you could put your profits to doing that, or maybe you could buy another dry cleaner rather than starting from scratch on some corner in your neighborhood somewhere. You say, well, why do that? There's a neighborhood dry cleaner down the street that's doing pretty good, a great location. And if the price is right, we'll just buy that dry cleaner. So there are different ways to expand. You may also expand without opening a new location. Maybe you expand into different types of work at the location you have. But the point is, a second option for your money would be to expand in some way. A third option would be just to hold on to some of it for a rainy day. Corporations, the largest corporations in the world, hold on to cash for emergencies, just like you and I, hopefully. Hopefully you do. I know I do. I hold into some cash for some emergencies. So maybe some of it's just, let's just keep some of the cash in the business. You never know when maybe the business will go down a little bit, or we'll have an unexpected expense that we need to cover. So we want to just keep some money for emergencies, or we want to hold on to the cash. Maybe we want to expand, but there's no great deal right now. We want to wait for that golden opportunity. That's what Warren Buffett does. He says, I think the number's $20 billion. He keeps at least $20 billion cash and short-term securities on hand. That's a heck of an emergency fund, huh? But that's what you might do. You might just say, hold on to some of the cash for emergencies and for some future opportunities down the road. Another thing you might do, and this would be the case if there were, say, multiple shareholders, you might buy back some of your shares. You might buy out some of the shareholders as a company, and that could be an option. And for the remaining shareholders, the result would be that they would own a larger slice of the pie. They would own a larger percentage of the business. Their number of shares wouldn't have gone up. The company would have simply bought out other shareholders and then canceled those shares. But the result for the remaining shareholders is that they would have a larger stake in the company. And that's an option. But a final option would be a cash dividend, right? You could say, well, we're going to pay out some money to the investors. And you probably wouldn't pay out all $1 million, right? For starters, as I mentioned, you have some capital improvements that you might have to make. You probably want to keep some cash on hand for emergencies and for future growth opportunities. But unless you've got really great uses for all of the cash, you might decide to pay out some of those earnings, some of that profit, to the shareholders as a dividend. And, of course, that gets us to the main topic, right, what we're talking about today. It's no different at Apple or Ford or Microsoft. Pick the largest companies you want. They make money. Hopefully, they earn a profit. And they start to pile up cash, hopefully. And the first thing that they're going to look at is, how can we need to maintain our business. Ford needs to continue to invest in equipment, manufacturing equipment. A utility is very heavily intensive capital expenses with the utility. They've got to continue to update and keep up to date their infrastructure. So depending on the business, you're going to have different capital requirements, but they need to take some of their profit and reinvest it in the company just to maintain the business that they have. And they may want to expand. Apple, for example, I'm going to use Apple as an example a lot today. It's a company that I own shares in. They bought Beats, right? The, headphone company. I think it was $3 billion. So they wanted to expand their business. So they took some of their cash, their hard-earned cash, and they expanded. And that's one of the things that they did. And of course, they have a lot of cash on hand, but they also pay a dividend. They pay some of the money that they earn back to shareholders. And again, it's no different than the dry cleaner example that I mentioned to begin with. It's just a little more complicated, I suppose, and a little larger, bigger numbers we're talking about. We're talking about billions, not millions, but it's the same exact concept. So what I want to mention here is three. We're almost to the video part of this, by the way. I want to mention what I call 3 dividend guidelines. I call them guidelines. They're not rules. This is not always the case, but they are guidelines. And you'll see why I mention this in a minute. The first is that dividends are generally paid in cash, right? Now, when people talk about dividends, they're thinking about cash dividends. They don't have to be paid in cash. A company could issue a stock dividend and pay dividends in the form of stock. But when you hear about the dividend yield of a company or that they paid a dividend, they're talking about cash dividends. That's the first guideline. The second one is that dividends are typically paid quarterly, once a quarter. No rule that says they have to be. Companies sometimes issue special dividends, but generally they're paid 4 times a year, once every quarter. And the third sort of dividend guideline that I want to mention is that dividends, if a company is doing well and they're growing, they typically increase their dividends once a year. So they'll pay the same dividend each quarter, and then once a year, the board will meet, management will make some recommendations, and if things are going well, they will choose to increase the dividend by some amount, and then it stays at that same rate for the entire year. Again, it doesn't have to be that way. I mean, unlike interest payments on a bond, for example, companies aren't legally obligated to pay a dividend. They could change their mind and not pay a dividend the next quarter. They could lower it. They could raise it. So this isn't. That's why I call these guidelines. These aren't rules, but generally they're paid once a quarter, and increases are once a year. And you'll see why those sort of guidelines are helpful and important as you start to evaluate companies and their dividend payments. And then the last thing I want to mention before I walk through some very practical examples and start this video recording that I've mentioned here now several times is something called the dividend yield. We're going to be talking a lot about the dividend yield during this series, but I want to mention it here briefly. The dividend yield is it's a very simple calculation. You take the annual dividend payment, the actual dollars, how much per share in dividends, and we're going to talk in a minute about how you can figure out what that is. But you take the annual dividend payments a company issues and you divide it by the price of the stock, and that gets you your yield. So, for example, if a company is paid out $2 a year in dividends and they're trading at $100 a share, 2 divided by 100, 2%. That's their dividend yield. Now, the interesting thing is that, of course, the price of a stock changes throughout the trading day. It can change a lot from day to day, week to week, month to month, and every time it does, its dividend yield changes. Now notice, though, the dividend yield can change without the actual amount of the dividend payment changing at all. As I mentioned, they typically only increase the amount of dividends once a year. But throughout the entire year, the yield is changing as the price of the stock goes up and down. And here's the thing to keep in mind. As the price of a stock goes up, the yield goes down. Right, and that makes sense. In our example, if it was $2 per share in dividend and it was trading at $100, imagine if the stock just went through the roof and all of a sudden was trading at $200, but the dividend was still the same. Well, 2 divided by 200 is now 1%. So the price of the stock went up, the yield went down from 2% down to 1%. And of course, the reverse is true. If the price goes down, the yield goes up. By the way, bonds are the same way. If the price of a bond goes up, yield goes down. If the price of a bond goes down, yields go up. That's important to keep in mind. It may be a little difficult to wrap your mind around, at least it was for me as I was learning all of this. But I think as we work through this series, that will become more clear. Now, here's what I'm going to try to do on the video is I'm going to talk about how you go about finding out how much a company pays in dividends and what the dividend yield is. So we're going to talk about those things. But I want to do it in a video so that even if you're not where you can watch the video now, if you want to go back to it later in the show notes, you can watch it. And I think it's just going to be a lot easier to work through. And so that's what I'm going to do. I've got a software that basically records my screen, my computer screen. And so I'm going to start that here in a minute. In fact, I'm going to start it right now. And what will happen is if you go to the show notes, you'll be able to see this video, and you can play it, and you can see exactly how I am finding out how much the company pays in dividends, what their dividend yield is. And in fact, right now we're at Google Finance, google.com/finance. And what we're going to look at today is Apple. It's a company that, as I mentioned, I've invested in. I still have shares of Apple, and it's a company I'm very familiar with. So the ticker is AAPL. So in Google Finance, you'd simply type in AAPL, and it brings up a snapshot of Apple. And we can very quickly see what its dividend and dividend yield are. And we can see here the dividend, they say, is 47 cents a share, and the yield is 1.97. Now, you remember I told you how we calculate yield. You take the dividend and you divide by the price of the stock. Well, if I bring up my trusty calculator, which I will do here, and we try to do this math, we're going to find out very quickly that it doesn't work. If we take 0.47, 47 cents, and divide it by the current price of the stock, which is about $95.70 as I record this video, it doesn't come out to 1.97%. It comes out to about 0.5%. Now, why is it off? Well, we're going to talk about that in a minute. Before we get to it, though, let's go to Yahoo Finance. We can search for Apple there as well. And when we do, we get different numbers. We get a dividend of 1.88 and a yield of 2.1%. What in the world's going on? Why are Google Finance and Yahoo Finance so different for the same company? Well, before we answer that, let's try one more. My favorite, Morningstar. Going to search for Apple. Here we see, it's pulling up, they don't give us the amount of the dividend, at least not right in the main screen, but they give us a yield, and it's different yet. It's 1.81%. So here we have three well-known personal finance and investing sites. The yield for all three are different, right? We had a yield of 1.97 on Google, 2.1% on Yahoo, and 1.81% on Morningstar. And for the two that show us the dividend payment, we have 47 cents for Apple, and we have $1.88 for Yahoo. What in the world is going on? Okay. Well, fortunately, the explanation is not that difficult. You just have to dig into the details. So the first thing is, with Google Finance, what they report is not the annual dividend. They report the quarterly dividend. And you'll see this if you put your cursor over the dividend yield. You'll see latest dividend is divided per share paid to the shareholders in the most recent quarter. So they just showing you the most recent quarterly dividend. However, the yield they're calculating based on annual dividends. That's just how Google Finance does it. And in fact, if we bring our calculator back over and we take 47 cents and we multiply it by 4, and then we divide it by the current price, which of course is fluctuating even as I recorded this video, we'll see it's right at 1.97%. So I can make it a percent. Well, I just went backwards, but you get the idea. 1.97%. So the numbers work out. So Google Finance reports the dividend on a quarterly basis. That's just how they do it. Yahoo reports their dividend on an annual basis. They just take the current dividend, 0.47, and multiply it by 4. You get $1.88. That's what they report. Now the question becomes, well, wait a minute. Okay, that explains the dividend, but why is the yield reported on Yahoo Finance 2.1%, whereas the yield on Google Finance is 1.97%? The answer is simple. Yahoo Finance is wrong. It's as simple as that. This is not updated. Google Finance updates their yield throughout the day. This will change as the price changes. Yahoo Finance is out of date a bit. I don't know how often they update their yield, but they don't do it daily. That underscores an important point here, and that is, while these sorts of sites can be very, very helpful, you have to recognize that they can also, from time to time, be wrong. And so that raises the question, well, wait a minute, how can I double-check folks at Google Finance and Yahoo Finance to know what the company's actual dividend payment is? How do I know if they're right? Well, we're going to come to that. But before we do, I don't want to forget our friends over here at Morningstar that show a yield of 1.81%. Why is their yield different than Google Finance? If we think 1.97% yield at Google Finance is correct, why is Morningstar 1.81%? Well, the answer there is that what Google Finance does is it takes the most recent quarterly dividend, multiplies it by 4, and calculates the yield. What Morningstar does is it takes the dividend payments from the last 4 quarters and divides by the current price. And the dividend for the last 4 quarters may not have been 47 cents every quarter, because during the last year, Apple raised their dividend. So some of those quarters, if you go back in time, are a slightly lower dividend payment. Now, you might be saying, okay, I get that, but which one's right? Well, there's not any sort of right or wrong there. It's just 2 different ways to calculate dividend yield. The way I look at it is the Google Finance way. When I'm looking at a company, I take a look at what its current dividend is, multiply it by 4, and calculate the yield, because that's what I can expect to earn over the next year, or at least until management and the board of the company decide to potentially increase the dividend. So I look at I sort of approach it from the Google Finance way. What's its current dividend, quarterly dividend, multiply it by 4, take that number and divide by the price, and that's what I use for dividend yield. And of course, as I record this podcast today, Apple stock in the market as a whole, but Apple's down 2.7%. So remember, as the price goes down, what happens to the yield? It goes up. And so the yield is going up today as the price goes down, even though the actual dividend payment hasn't changed. The next quarter, they're going to pay 47 cents a share. That hasn't changed, but because the price has gone down, the yield has gone up. Now, where can you check all this on your own? If you wanted to see how much the company, sort of the official statement from the company about how much it's going to pay in dividends, or how much it did pay, where do you go? Well, the best place is their annual and quarterly filings with the SEC, the Securities and Exchange Commission. So I'm going to go to that site now. It's sec.gov. And again, I'm showing this on the video. If you're listening to the audio, you can watch the video if you'd like when you get an opportunity. But you go to Company Filing Search, and the easiest way is to type in the ticker in what they call the fast search, AAPL. This will bring up Apple, and I'm going to look for their latest either 10Q, which is their quarterly filing, or 10K, which is their annual filing. I see their 10Q right at the top. This was filed really just a few days ago, July 23rd. So if I go to the document, and if you've never done this before, it's probably going to seem more overwhelming because you see all these links. It may not be crystal clear, but you'll see the description. 10Q is right here. We're going to open it up, and here's their latest 10Q. We can go right to, it's on page 3, their condensed consolidated statement of operations. This is their income statement. And it shows net sales, cost of sales, operating expenses, and everything on their income statement. And if you go all the way to the bottom, cash dividends declared per common share. Sure enough, you go over to the June 28th, 2014 quarter, and you'll see 47 cents. You'll also see the year ago, this is June 29th, 2013, it was 44 cents. So between a year ago and today, they've actually increased their dividend, which they did about, the quarter before. But sure enough, we can see 47 cents is, in fact, their current quarterly dividend. So, in fact, if we go back to Google Finance, sure enough, they got it right. Now, one thing I'll say on the SEC website, this is their Q that we're looking at. If we go all the way back to their listing, they have something called interactive data. It's a link right next to the document link. Again, you'll see this in the video if you're just listening to the audio. This can be an easier way to look at a company's financial statements on the SEC website. You can go to their financial statements, condensed consolidated statement of operations, and you'll see basically, exactly the same numbers, but in a much easier sort of format to read. And sure enough, let me get rid of this. If you go to the cash dividends declared per common share, you see the same 47 cents. Just another way to see the same information. I think it's generally a little bit easier. So that's going to conclude this video. And I've just stopped the video. And again, if you're listening to the audio, I think hopefully you'll find that video helpful. I'd like to hear from you. I know it's kind of a little awkward to do a video and a podcast at the same time, but if you get a chance to watch the video, shoot me an email at dr@DoughRoller.net and let me know if that's helpful to walk through it visually. I know it helped me as I was learning this. I guess a visual learner, but let me know if that helped you, if you have a chance to watch the video to walk through how I did that for Apple. So that's what a dividend is. That's how you determine how much in dividends a company is currently paying, how to calculate the dividend yield. We also walked through why different sites can show the dividend and the yield differently, and that's important to understand because as you use different websites, you will see different numbers, not just with the dividend and dividend yield, but just about every important ratio you might want to calculate about a company, including something as quote-unquote simple as the price-to-earnings ratio, the PE ratio. Now, I know I've kind of run through this stuff quickly. This is, again, just part one of our series on dividend investing. But before I close out today, I want to kind of give you some high-level thoughts on dividends. The first is this. Some people think that a company that pays a dividend is a better investment than a company that does not. I do not agree with that. Just because a company pays a dividend doesn't make it a good investment. And just because a company doesn't pay a dividend doesn't mean it's a bad investment. Berkshire Hathaway, Warren Buffett's company, does not pay a dividend. Trust me, I've owned shares of Berkshire for a long time. It's been a great investment. Apple, until just about 2 years ago, didn't pay a dividend. Was a great company, is a great company, and had phenomenal success, as we all know. So just because a company doesn't pay a dividend doesn't mean that it's a bad investment, and just because a company does pay a dividend doesn't mean that it's a great investment. You still have to look at the underlying company. That's the first thing. The other thing is, I almost all, except for Berkshire, all the companies that I own, individual stocks pay a dividend. And that's very important to me. I think there are a lot of advantages to a company that pays a dividend. But before I get to them, there are some disadvantages. If you think about it, people talk about using dividends as a way to fund retirement. It's an option. But think of the disadvantages to an investor when a company pays a dividend. What are they? Well, first of all, the company decides on the timing, not the investor. Right? If you need your money and the dividend check isn't coming for 2 months, you got to wait. It's totally up to the company if and when they pay a dividend. Number two, the company decides how much. The dividend may or may not meet your needs, but the company decides how much the dividend is going to be and whether it's going to be increased from year to year, decreased from year to year, or whatever. Third, when dividends are paid, it typically triggers taxes, certainly if it's in a taxable account. It's going to trigger taxes, at least for, I think, most folks. There are maybe some exceptions. But there are tax consequences to dividends. So, timing, amount, taxes, those are all very negative things when it comes to a dividend. In an ideal world for me, I would be investing in companies that are growing and management is allocating their capital so well that they can use all of the cash that they generate to grow their business, grow their earnings in a very smart way. That would be in an ideal world. Unfortunately, that just generally doesn't happen. But the point is that dividends, there's pros and cons to just about everything in personal finance and investing. That's true with dividends as well. Receiving dividends, there are some negative aspects to it. If you want to generate income, a great way is to simply sell some of your shares. You control the timing, you control how much you sell, and generally taxes on capital gains, long-term capital gains, can be better than taxes on dividends. Again, that's depends on your specific circumstances, but certainly for a lot of folks, taxes on capital gains can receive more favorable treatment than taxes on dividends. So a lot of negative things relate to dividends, but there are also a lot of positive things with dividends. The first is, and I think probably in some ways the most important, is that it forces management to think of its investors. I think one of the biggest risks of investing is if you start to invest in a company where management doesn't put the investors first. The CEOs of these companies, the CFOs, they're human beings just like you and I. They can be greedy. They can be prideful. all of the traits that all human beings have. And I've met CEOs before who were great at business in some ways, but were terrible at allocating capital. And they got their egos involved, and they wanted to grow their business, and they wanted to buy up the competitors, and they wanted to expand globally so that they could say they were the CEO of an international company. And the result was they just frittered away the capital of the that belonged to the investors, and they made bad decisions. And when you pay a dividend, when management's consistently paying a dividend and consistently increasing that dividend, it forces them, at least to some extent, to put investors first. And I think that's the kind of mindset you want from the management that's running your company. These are our companies. We own them. Management doesn't own them unless they're shareholders. The shareholders own the companies, and paying a dividend forces management to, as they're thinking about their expansion plans and the things they want to do, they got to say, well, wait a minute, we don't have all this money. We got to give some of this back to investors in the form of a dividend. That's the first thing I like about dividends. The second thing is it's a great way to earn income from an investment that is not directly dependent on the market's ups and downs. Even when the market's falling, assuming that the companies are still doing well and can continue to pay their dividends, it's not always the case, but assuming that it is, you can continue to earn income from your investments even while the market is falling. And I think that can be a huge benefit. And the other thing with dividends is typically it's the more mature companies that are paying dividends. They've been around for a while. They have a good track record. And again, these are generalizations. They're not universally true. But as a general rule, they are. And that's for those reasons, it's why I tend to focus on stocks that pay a dividend. Now, I know I've kind of run through this first part, this part one of our series pretty quickly, and I know I've kind of thrown a lot at you. If you have any questions, shoot me an email. You can check out the video if you go to the show notes. The show notes will be at DoughRoller.net/podcast 96, podcast 96. Now, the other thing I want to mention as we move forward in this series, I know a lot of you just invest in mutual funds and ETFs. Dividends are just as important with mutual funds and ETFs, and we're going to be talking a lot about them in the upcoming podcasts in this series, including how to figure out what the dividend yield is of a mutual fund and what the dividend yield is of an ETF. They have dividend yields just like stocks, and they pay out dividends as the underlying companies that they own declare dividends and pay out dividends. So we'll definitely be talking about that as well, not just individual stocks, but we got a lot to cover with dividend investing. This is again just a precursor, an appetizer, I guess, if you will. So more to come, but I wanted to start off with sort of the basics. There you go. Again, if you have any questions, shoot me an email at dr@DoughRoller.net. Also, again, please let me know what you think of the video. Hopefully it came out pretty well and helps you visually see exactly how I'm looking up these companies. That will become even more important as we get into some of the more meatier stuff as it relates to dividend investing. Understanding how to look this stuff up and do the calculations yourself is extremely important. So there you go. That's part one of the dividend series. There'll be more to come in the days and weeks ahead. Hope you enjoyed it. Have a great day. Until next time, remember, the best thing money can buy is a dividend-paying stock. There you go.